Price movement is up. Downtrends include a downward price movement. The sideways trend is shown when the currency pair is trading within a range and moving sideways. It's important to understand that under the right market conditions, any of the three types of trends can be traded. You'll most often trade the up and down trends, but you may also find yourself trading a sideways trend at times. This is especially true when that sideways movement is the larger trend, and the ups and downs fall into the midterm and short-term trends. Stages of a trend. When you're trading the trends, it's important to understand that there are stages to any trend. Unless something occurs to change the trend direction prematurely, these stages will generally be present, and understanding them will help you to enter your trades at the right time. Let's talk about the 4 stages of a trend. Stage 1, the beginning, the nascent trend. When a reversal occurs and a new trend starts, we enter the nascent stage of the trend. The trend is just beginning, and traders don't yet have confidence in the trend itself. This means you should expect large price jumps and see the price retest levels that occurred before the trend started. This stage of the trend is where you'll find aggressive traders entering their trades. It's also the point of a trend with the greatest risk of failure. When a trend is just beginning, it isn't well established yet, and it is still possible for the price to turn around again. Stage 2, the fully charged trend. When a trend reaches stage 2, we call it the fully charged trend. The trend is established, price movement is confident, and there is little room for any uncertainty about the direction of the trend itself. Experienced and inexperienced traders alike are confident in the trend, and with that, their trades drive the price movement in a steady direction with that trend. This is the ideal stage for the less aggressive trader to get in on the trend. After taking a look at the technical analysis and support resistance levels, the trader can confidently get in on the trend with a high likelihood of a profitable trade. Stage 3, the aging trend. Eventually, any trend gets tired. At this point, you have experienced traders losing confidence in the trend and inexperienced traders still trying to jump in to grab some profits from the trend. The aging trend can be seen by stages of price consolidation and chart patterns such as double tops or bottoms. Again, this stage of the trend is mostly traded by aggressive traders hoping to grab a few more pips from the price movement. You'll also find inexperienced traders who don't realize the trend is aging jumping onto the trend at this point. Stage 4. End of trend. Finally, after the slowing period of the aging trend, we find the end of the trend. That is the point where the experienced traders and the long-term traders are taking profit. The close of all these trades usually leads to a reversal. Whatever the case, the trend no longer has steam to continue, and you shouldn't be trading that trend at this point. The potential for continued price movement in the original trend direction is limited, and any trade at this point can go either way. As shown by the chart on the next page, all trends have 4 stages. Learning how to recognize these and determine what stage the trend is in is important to be able to ride the trends profitably. Charting the trends. If you're going to trade the trends, there are 2 things that you need to be able to do well. First, you need to be able to clearly see the trends on the charts. Next, you need to be able to gauge trend strength and determine the best point to jump in on the price movement. Having these skills will ensure that you win more trades and grow your account over time. Luckily, trends aren't really difficult to chart. You'll need the skills to draw trend lines, to see support resistance levels, and to read a few technical indicators that will help you to determine trend strength. To start, let's talk about trend lines. Trend lines. A trend line is simply a line drawn on the charts that connects the price movement to show the trend. When drawing trend lines, you don't need the line to connect every point on the chart. We know that prices tend to move in waves, so that actually won't work. Instead, you want to draw your lines so that they connect to at least 3 points on the chart. Shown below, you can see an uptrend and a downtrend on the GBP/USD 1-hour chart. It's important to note that your trend lines may change as the trend becomes more established. Looking at the chart above, if you had drawn the same trend line for the downtrend earlier, the trend would have had much less slope. By the same token, if you had drawn the line for the uptrend at the beginning, the line would have had a much greater slope. Another important thing to note is that trends aren't just up and down. There can also be sideways trends. Trend lines can be useful for determining the direction of the trend, obviously, but they can also help you gauge when it's best to enter the trend. We know that currency price will usually move in waves. From that, if you draw a line, you can gauge how far the price is currently away from that line, which will help you to determine if now is a good time to enter or not. To make it simpler to use the trend lines that you draw, you should draw a downtrend line above the price and an uptrend line below the bars or candles. Support resistance. Once you've drawn your trend lines, you'll also want to look at support resistance levels. These levels will be in places where the currency price may have trouble breaking through, and entering a trade when the price is about to hit a major resistance level can lead to failed trades. Although if the trend is strong enough, the price may break through the support resistance. It will usually bounce first and may bounce off that level 2 or 3 times before making its way through. Luckily, using historical data, it's quite simple to chart supports and resistances. You should do this on the charts that you're trading and on the 2 time frames longer. For example, if you're trading from the hourly charts, you should know the major support resistance levels for the 1 hour, 4 hour, and daily charts. Looking at the GPB CHF chart above, it's clear to see that 1.6055 is a major resistance level. Every time the price has reached that level, it has bounced. You should list out the major supports and resistance levels before making any trade. Using the example above, the price is nearing that level again, so trading now would be a bad idea. Another important thing to note is that support resistance levels don't necessarily have to look like straight lines on a chart. The trend lines we drew earlier also represent support resistance, as the price will tend to bounce off the line as it moves up or down with the trend. Determining trend strength. The next thing you need to be able to do is determine trend strength. This will help ensure that you get in on the trends at the right time. It will also help when it comes to determining how to manage the trade, i.e. where to set stops and when to take profit. There are basically 3 ways you can determine the strength of a trend, and you should be familiar with them all. The methods we'll be using are price action, the actual movement of a trend shown with the slope of the trend line, correction, and consolidation, how the price moves throughout the trade when it consolidates and resumes movement with the trend. Technical indicators. We'll talk about ADX, stochastic, and MACD to help you determine trend strength. Let's discuss these 3 elements in a little more detail. Price action. The first thing we need to talk about is the price action. This is simply a measure of how fast the price is moving in one direction or another. In the chart shown above, you can see a steep trend line. There are no clear support resistance levels, and the price has simply shot up for a period of 13 hours. Unless you're an aggressive trader, these types of trends should be avoided. Steep trends tend to run out of steam quickly and will cause your trades to get stopped out with share reversals. This is actually the reason we watch the price action. It isn't that you can't profit from a steep trend, it's just that most traders will profit less often in this type of trend. Consolidation. Next, we need to talk about correction and consolidation. In any trend, there will be periods of correction consolidation where the price reverses for a time and then continues on with the major trend. These corrections are an easy way to gauge the strength of a trend. If the trend is strong, these periods of correction will tend to be short, and they won't necessarily retest previous support resistance levels. As shown on the chart on the previous page, a strong trend will have narrow consolidations that look like a rectangle or a flag, and the reversal in price movement will be short-lived. Technical indicators. Finally, to really determine the strength of a trend, we use technical indicators. This will help you to determine whether or not now is a good time to enter or not, and in turn help you to avoid some of those losing trades. ADX, Average Directional Movement. The ADX, or Average Direction Movement Indicator, is often used with trend trading systems to show price movement and trend strength. However, since the indicator tends to lag a lot, we won't be using it here, and we're really only covering it to show why you shouldn't use it to ride the trends. As shown on the chart above, the ADX indicator usually lags as far as trend strength is concerned. In both places shown by the arrows, the strong price movement wasn't really shown until after the best time to trade had happened. Of course, you could use this indicator, as some traders do, to just ensure that it's pointing up to indicate strong price movement. Our preference is to use 2 other indicators though. Stochastic. The stochastic indicator can be a great indicator to help you trade the trends. It's a good indicator of price movement, and since it moves up with the upwards price moves and down with the downward price moves, it is easy to read and use to trade the trends. As shown above, the stochastic indicator tends to move with the price. As the price is making higher highs in an uptrend, the stochastic is also making higher highs. As the price reverses, so does the stochastic. This makes it a simple tool to use to trade the trends. If the price and the stochastic are on the upward slope in an uptrend, it's a good indication of a strong uptrend. By the same token, when it's on the decline in a downtrend, it's a good indication that the trend has steam left and can be traded profitably. MACD. As an alternative to stochastic, the MACD, Moving Average Convergence Divergence Indicator, can also be used to trade the trends. The idea here is similar to the one we share for the stochastic indicator. Only in this case, we look at the histogram of the MACD.